Hello and welcome to today's Market Matters video update. I'm Harry Watt, joined by James Gerrish. We are Tuesday, the 14th of November. We're going to talk about a few things today. We're going to talk about portfolio performance in a pretty tough October. We're going to talk about looking ahead. 2024 is just around the corner. We're also going to talk about some of our best ideas here and now. But kicking it off, obviously a pretty brutal time for markets. Months leading up to October and October in particular, James, how did the Market Matters portfolio stand up in that time?
Yeah, you're not wrong, Harry. So October was a poor month for the market overall and our portfolios in a general sense, so relatively speaking, and that comes on the back of a couple, difficult couple of months in terms of market. So just to give you some high-level numbers, so the active growth portfolio published on the Market Matters website was down 4.8%. It was about 1% below the market. If I look calendar year to date, it's up 9.5%, which is up against a market which is down slightly. So it's strongly outperforming on that metric. And on a one-year view, it's 12.63% again versus the market, which is up less than 3%. So all going well on longer time frames, but we had a tough October. There's no two ways about that. Income portfolio down 2.7% in terms of October, underperforming its RBA cash plus 4% benchmark, which was up nearly 70 basis points. So on a one-year view, that's up 9.02%. So again, above its benchmark. And again, from a longer-term perspective, still stacks up. International equities portfolio down 3.3%. There's not a lot of good news right across the board here, Harry. The MSCI in Aussie dollar terms was down 1.02%, so it did underperform by about 2.3%. One year view, it's up 9%. It's slightly underperforming its benchmark, which is up 11%. And on a calendar year basis, it's up 16.8%, outperforming its benchmark. So some swings and roundabouts there. Then the emerging companies portfolio was down nearly 9% on the month. The small odds were down 5.5%, so underperformance on a monthly basis. If I look calendar year to date, it's down 1.6%. The market is down 6% in that time frame. And over a one-year view, it's up slightly and the market is down 5%. So, look, not a great month in terms of portfolio performance, and it caps off a reasonably tough 3 months. Just to give you an idea, in the last 3 months, the ASX 200 accumulation index is down over 7%. The small caps are down over 10%. So the backdrop for equities has been a pretty tough one, but we are entering a seasonally strong period for equities going into the back end of the year. So we're hoping, and there's some early signs that the market has bounced in the first couple of weeks of November, Harry.
Just on that performance, James, obviously our call leading into that period was started to build more allocations into growth equities and into the market. Is that sort of why we sort of underperform, maybe being a little bit too early into this rally?
Yeah, absolutely. I think we were too early on two fronts. So we're too early on calling the peak in bond yields. I think we've now got evidence that bond yields have peaked, interest rates globally have peaked, and we're going to see lower bond yields moving forward. And that fed into our view around equities. So we went into a weak period, largely fully invested. So we didn't have the flexibility across our portfolios that we like to have in those sorts of down periods. So that said, monthly view is obviously a weak one, and underperformance is never great. But if you look at the time frames from a more broad sense, if I look at over the past 12 months what we've achieved, we're comfortable with what we've delivered over that time frame. So we look forward now around positioning portfolios for what comes into 2024, and that's certainly what our focus is now, Harry.
So pretty daunting. We're already starting to talk about 2024. We're midway through November, so there's only about 6 weeks left until we tick over into the new year, James. What's the sort of backdrop? Like, I know you mentioned bond yields sort of coming away. Is that something we expect to continue into the back end of the year? We're looking to add some more commodity exposure into 2024. Where's our view in markets for the rest of this year into the start of next year?
Yeah, I mean, the macro environment's really important at the moment. So I'd sit here and say that markets are all about probabilities rather than certainties, and I think about 3 scenarios going into 2024. So the first scenario is that central banks have done a good job wrestling inflation back down towards their targeted levels. Interest rates have been risen enough, but not too much to send growth really flying off the, really coming back hard and having all the implications of rising unemployment and the like. So that's a scenario where a soft landing plays out. So I'd liken that to about a 60% probability at the moment. So there is signs that that's actually playing out, that in 2024 we might see this scenario where economic growth does cool, but not a lot. Inflation does come back towards the targeted levels. Unemployment stays, or employment markets stay strong, etc. The Fed and others could put in a couple of interest rate cuts just to ensure we've got a smooth landing. So that's describing the Goldilocks scenario. That's going to be really bullish for markets, and I expect the ASX 200 to have an 8 in front of it in 2024 if that was to play out. Scenario 2 would be that they go too hard, and only time will tell around whether they've gone too hard in terms of interest rates. That could have a bigger impact on growth, so growth may slow more than they were hoping, and we could go into the recession type scenario. I think in that environment we have a tougher first half, but you've got the silver lining to that is they've got a huge amount of room to stimulate. Interest rates have been ratcheted up really aggressively, so they've got a lot of room to cut interest rates. So in that environment, I'd expect them to cut aggressively, and the second half would probably be positive for equities on the back of really supportive monetary policy once again. So that suits itself to active management. And I think thirdly, on the point 2, I'd say that's about a 30% probability. So I'm more in the camp of scenario 1, Goldilocks, deep recession possibility, but we still think that central banks can be supportive in the second half of 2024. And then the third one is around stagflation, which stagflation is what we all don't want. You live through the 70s, you'll know how difficult it is. It's around rising inflation but slowing growth, rising unemployment. For that to happen, you need a big shock. So oil markets are generally a cause of those sorts of shocks. Not out of the question given the geopolitical situation globally, but still a long shot in my view. So I think Goldilocks scenario is more likely to play out. That's going to be bullish for equities, and that's how we're positioning going into the back end of 2024. But with these other probabilities that might come along as we move into the back end of the year and early next.
All right, so given that backdrop, given the ideas around probabilities on markets, we're going to move on to some key picks here and now across all 4 of the key portfolios that we manage with Market Matters. Starting with the income portfolio, James, a bit more of a defensive skew to the portfolio, a bit defensive skew to this position. You're going to call out infrastructure heading into 2024. Why is this your key pick in this portfolio?
So I'm going to be really quick here. So infrastructure, we like it when rates are falling and inflation is falling. Infrastructure has been really had a tough 6 to 12 months. APA Group is the key pick there. It's been weak. The other one I'd call out is Transurban. I noticed that, so we don't hold it in the portfolio, but it's been weak as well. It's yielding over 5%. So go and have a look at infrastructure in this type of environment. Defensive, high yield, and has been knocked for 6 on the back of rising bond yields.
Bit of a different skew there. Moving on to the growth portfolio, mineral resources, obviously a bit of iron ore, a little bit of lithium in that position, a lot more riskier than the infrastructure you just spoke about, James. What are the key reasons why we like MinRes?
Yeah, Min. I mean, lithium has been knocked about 75% in terms of prices. They've got a large exposure to lithium, but they've also got a large exposure to iron ore, which has been a lot more resilient than people had thought it would be. So I think the lithium price is near a low. The iron ore price is going to stay higher for longer, and that's going to be supportive of Min earnings. So a bit of a contrarian play around $60. Min looks good for the growth portfolio, Harry.
Iron ore's been stubbornly high for so long. Everyone's been calling downside to iron ore for so long, and it just hasn't really moved. So very supportive of Min.
Absolutely. Emerging companies. Let's get the growth stock out of the way. You've done Aussie Broadband.
Aussie Broadband, yeah. It's our biggest position in the portfolio, and for good reason. I think they've been a little bit soft over the last few weeks after picking up Symbio. They're trying to get that deal over the line at the moment. I think that's a cracking deal for Aussie Broadband in terms of how it develops that business, what it can do for its enterprise business in particular. Just really broadens out the scope of Aussie Broadband. It's cheap. It's growing above market. Optus have had issues, so that's going to prove a tailwind. They're even taking market share off Telstra, so the key telco in the space. I think that's a big tick and really good momentum.
Hopefully they don't take too much. We've got Telstra in our income portfolio, and they're raising capital at the moment, so existing shareholders can top up their existing position. So you might see a little bit of weakness in the share price, and that's what we're highlighting. That's the opportunity to go out there and buy it. And then in terms of the national equities portfolio, I'll wrap up by saying HCA Healthcare. HCA over in the US market, large hospital and private healthcare provider over there. We've owned it about 12 months ago, did really well out of it. We've just bought it again in the international equities portfolio, so it looks good around this 230 a share mark, Harry, and that's all we've got for you.
That's all we got today. We're going to be back in front of the camera before Santa arrives, so expect another video before the end of the year. There's plenty more to go in 2023, but look out for a big 2024 as well.